What's up, everyone? Hope you guys had an amazing weekend. Hope you guys have a spectacular end to your Sunday as well. In this video, we're going to take a look at all of the news and everything that's going to take place this week. This week might end up being one of the most important weeks of the year. And we're going to take a look at all of that. We're going to take a look at some historical data on CPI and how that affects the opening price of the next day. I'm going to share with you guys some interesting data that I collected. And then we're just going to move forward and see what the next steps are for the market. All right. So without further ado, let's get started with the video. All right. So number one, nothing really going on Monday in terms of big economic news. Tuesday, however, at 8:30 a.m., we're going to get CPI data. So that's going to be very important. Wednesday afternoon, we're going to get the Fed rate, and we're going to get the Fed rate and everything at 2 p.m. And then at 2:30 p.m., FedPal is going to give a talk. So Wednesday is going to be very, very important as well. Then Thursday morning, we get all of this unemployment claims, retail sales, all of this data at 8:30 a.m. as well. And then on Friday, we get some more data heading into the morning at around 9:45 a.m. with flash services PMI. So this is going to be a way more active week in terms of news than last week was. So real quick, I was pretty interested in seeing how CPI data affects the market, how much we jump depending on CPI data readings. So what I did was I went back to November 10th, 2021, and then all of these dates were from 2022, this year, obviously, right? So very simply, all I did was I got the close price of the day before, right? And then I got the open price of that release date, and then I checked for the percentage difference. So all I did, so this right now, what I wanted to basically do was, all right, can we throw a fixed amount of money to both calls and, say, for example, Monday, because CPI data comes out Tuesday morning, right? What I wanted to check was if at Monday at the close, if I throw, $500 at both calls and puts, a few dollars out of the money, what is the percentage that we're going, like one of them would be profitable? All right. So this is basically what I was trying to check for Monday night, right? So basically, you could get the percent. Basically, now you could see the percentage differences. And say, for example, we did that strategy on November 10th, it wouldn't have garnered a lot of money because there was only a 0.38% difference between when we would have bought and where we opened. So our goal for this strategy would basically be, like, obviously one side of the trade is going to go to zero, right? But then our goal would be the other side of the trade needs to be above 100% for us to be profitable overall. And on a day when there isn't a lot of movement, this would have lost money, both sides. This probably would have lost money. This would have lost money. A lot of these plays would have lost money because there aren't huge moves. But now the issue is that once you start coming into June, the percentage differences are much higher, right? And the percentage difference for November 10th was 3.7%. So this is starting to get a little bit interesting. Tomorrow, basically, based off of this data, especially with the last few months, if you were to throw a few $100s even at both calls and puts at the close, hoping like closest data expiration as well. So the closest data expiration, that would basically be, since Monday, you could probably buy Tuesday expiration and go a bit out of the money on both directions for the calls and the puts, and these look like they would at least be a bit profitable. So that's going to be pretty interesting. We're going to have to see if we should go ahead and do that. But what we saw with the first half of this data is that it's not really worth it because the difference in price wasn't high. But yeah, I just want to share that with you guys. It's pretty interesting to take a look at. So now heading into the price action itself, we were basically saying that 398 was going to be a good opportunity to go short. I said 398 to 400 was going to be the first opportunity to go short. If we ended up breaking above that, then 401 to 403 would be the next level to go short. And you could see on Friday, we did not break above 398. So 398 was that perfect level, a retest of a prior level of resistance, and we continued down lower. So you can see that we closed at 393, and we basically closed almost at our lows for the day. So this worked out really, really well. The momentum is obviously still falling lower. That's why I was expecting us to fall either between 398 to 400 or from 401 to 403. I was expecting us to fall either way. So things are looking really well for that, right? But now Monday, things can be very, very stagnant in anticipation for the CPI data numbers. And then Tuesday, things can move very abruptly. Then, it's very tough to say now what is going to end up happening with the market, because next week there's going to be a lot of news, obviously. CPI data Tuesday, FOMC rates and minutes and the talks and everything on Wednesday. So a lot of it can now change. So what we did, we were basically bullish down here because I was showing how the NASDAQ was putting in a reversal candle. So the NASDAQ was putting in a reversal candle here on December 7th, while the SPY on December 7th was at support, and while the IWM was also at support. So I was saying this was a good opportunity for a potential reversal led by tech, and that's exactly what happened. Tech led that little bounce here. And then I was saying it was a good opportunity to go short at those levels, and that's exactly what happened as well. So yeah, so far in the equities market, things are moving pretty understandably. The dollar is still looking very weak overall, but it's putting in a higher low, and we know that generally if the dollar goes up, then the stock market should be going down. And if the strength in the dollar can continue, then we should expect that the stock market should be falling. So let's just continue to take a look at that. And when we also take a look at the 30-year bonds, we could see that it fell, bounced off of the 131.30 level, and put in this very big red candle. But overall, this is not an entirely bearish setup. Obviously, this is still very, very strong on the bonds. We're still holding around the 130 level. We're still very, very strong above the 128 level. So even if we were to fall back down another day or two above this 127 to 128 level, this would still be bullish for the bonds. And we know that if the 30-year bonds are showing strength, then the stock market should also be showing strength. So this is not a warning signal on the bonds by any means at all. But the bonds do tell a story. So once we head into Monday and Tuesday, we could get a better understanding of which direction use the bonds as a gauge, because you could see what the bond market is saying about CPI data, or what the bond market would be saying about the FOMC fund rate or anything like that, because the bonds do a good job of telling that story. So there's that for the bonds. So now when taking a look at the VIX is continuing to show a lot of strength. This setup usually when on the 1 minute candle leads to a big pop to the upside. So that is still, yet to be determined. Obviously the VIX is heavily dependent on the SPY and the overall volatility of the market, right? So anything can change, but this is showing a very, very bullish move for the VIX. And we know that if the VIX is going up, then the stock market is going down. So this doesn't look good for bulls on the stock market, is what I'm saying. But this is just the VIX. This is an automatic reason to become bearish, right? But overall, I hope you guys enjoyed today's video. Make sure to like, comment, subscribe. Make sure to get some rest, eat well, take a nap, have a spectacular day, and I will see you guys bright and early tomorrow morning. Thank you.